Justin from Risk Parity Chronicles, bringing you a tutorial on Portfolio Charts' RiskReturn Chart. Now, before I start, this tutorial might be a little long because there's a lot to go into. If I make a mistake or if I fumble my words, I'm just going to keep going. Otherwise, these things take a long time. So bear with me. Here we go. First of all, some shout outs to Tyler, the creator of Portfolio Charts. That's all. That's the real genius behind all of this, is his work there. And also to Frank of Risk Parity Radio. We were in a little bit of contact about maybe some ideas for YouTube videos. He suggested this one, so I am running with it. Once again, I'm just sharing and explaining the work of others, and all credit goes to people who do the real work. All right, so what is this? This is a risk and return chart on Portfolio Charts. Usually we're up here in the portfolio section with the make your own portfolio page and adjusting them, and this is just a variation of that where you can see some new things. You get to it just by going to the site, go to charts, and it's there. Also, if you've gotten this on the blog, of course, it's linked right there. All right, so just to frame it a little bit, basically this is a tool that allows you to compare portfolios according to their risk metrics and their return metrics. So there are 18 preset portfolios, all the famous ones, all explained elsewhere on Portfolio Charts. If you're interested, I'll go over that in a second. But you've got those 18 already there, and then you can see how your own portfolio compares according to those different metrics. So you're going to enter in your information by asset class, which is important. I'll talk a little bit about that later. And what makes this such a wonderful tool is that instead of just the typical standard deviation for risk and average return for a reward, you get 5 different ways to calculate risk and 5 different ways to calculate reward. So, there are better things out there than just standard deviation for risk and average return for reward, depending on your purposes. So this tool is wonderful and allows you to mix and match those different things, and we'll go over 2 of my favorites in this little tutorial. Okay, just some help navigating the page. You may be wondering about the different metrics and those 10 different ones. I'll just show you very quickly where to find that. You get a sense of all of the different metrics right here on calculations. So you can kind of look at those and learn more. Now this one, Ulcer Index, I actually wrote about for Risk Parity Chronicles, so if you're interested on a lot more about that, you can go check out my blog post from March 31st. Just type that into the search bar up at the top, you'll find that. And you also may be wondering about the 18 portfolios, the presets, and you can find those by going down here and clicking that page, that link right there, which will bring you to the page with all the portfolios on it. You can read a lot more there, okay? So let's go on to the next thing. Some things to keep in mind. I always like to have these caveats and framing so that when you use this tool, you know what it says and what it doesn't say. Right, so this is a tool based on asset classes, not individual tickers. So therefore, you're going to get a broad look at how these asset classes have done. You're not going to get a lot of fine-grained sensitivity towards whether you had chosen this fund or that fund, if you had been in an index fund that tracked this benchmark or that benchmark. You're just getting a broad look at it. And Portfolio Charts has a lot of asset classes, but it doesn't have all. So you have to keep that in mind if you're interested in managed futures, which I'm a big fan of. Those aren't on here. So you have to kind of take, there's a lot, so it's not as if you have to make a lot of sacrifices, but you just have to keep that in mind that it's a very good tool for getting a sense of the major asset classes, but you're not going to have that individual fine-grained look like you might if you used another tool. Another great thing about Portfolio Charts is you get a really long data set since 1970. So you really get a sense of how these things have done through multiple cycles, through the inflation of the 70s, through the dot-com crash of the late 1990s and early 2000s, through the global financial crisis, through the corona crash, all of that stuff. You're going to get it all. That's great, and I really like a long data set. But still, just remember, this is just how things have done over the past 52 years. It's not saying how things are going to do over the next 52 years. So just keep in mind you're getting a broad 10,000 foot view on how these asset classes have done. Don't go Don't go thinking that these are guaranteed returns or that this is gospel or that it will be exactly the same. I don't know what the next 52 years will look like, but I'll be pretty sure it's not going to look exactly like the last 52. So take that into consideration. Also, I use tools like this to figure out directions and trends. I think it's important just to sort of take the macro sense of what these tools are telling us instead of getting hung up on individual, observations or points to prove. These aren't so good for that. Just sort of figuring out how things work generally is a much better use of these tools. And also, this is a great tool that you can just play with, and it's meant to be adjusted so you can get a sense of how changing allocations, changing asset classes can change the profile for different portfolios. All right, so let's get into it. How does it work? We're going to use Risk Parity Radio's Golden Ratio portfolio. So this is Frank's original. He's a big fan of mathematical symmetry, so you get this golden ratio of 42% U.S. equities. That's these two together make up that part of the ratio, and that's then followed by long-term treasuries at 26%, 16% of gold, 10% of real estate investment trusts or REITs, and 6% in cash. Now this is a very good all-around portfolio, very good metrics if you are in the withdrawal stage. This is akin to a golden butterfly, things like that. This is a very robust and somewhat conservative portfolio, suitable for when you need to really consistently withdraw from a portfolio. All right, so before I get there, let me actually go to the tool and I'll show you how to do it. All right, so got it right here. This is the preset, and the golden ratio has 21% in long and large cap growth, 21% in small cap value. Make sure you take off these numbers of the preset ones. Of course, it decides sitting there too long, so I'll tell you what I'm going to do. Sorry for this, I'm just going to refresh. Sometimes portfolio charts kind of times out. Bear with me. All right, so it's going to set up with 60-40, and I am going to change that to, wait for it. All right, here we go. Large cap growth. Make sure you get rid of that original. Sometimes you leave that on and you get a wildly optimistic portfolio. 21% small cap value, 26% long-term treasuries. Take that down to 0. We have 10% in REITs, 16% in gold, and cash over here is going to be his T-bills, so we're going to put in 6%. All right, so there we go. Adds up to 100%. Now we scroll down, and here we go. This is the risk and return chart. Now, the defaults for here are sort of not the typical ones, so I think just to show you here, I'll go back to the most commonly used metrics for risk and return. That'll be standard deviation for risk and average return for return. And here we can see the golden ratio portfolio, my portfolio here, in comparison to all the other presets. You've got the total stock market way over here as an outlier, standard deviation about 17%, but also the highest return. Meanwhile, you've got on the other side the permanent portfolio. This is Harry Brown's 25% stocks, 25% bonds, 25% cash, 25% gold. Over here is the most conservative one, down at about 7% standard deviation and about 5% average return. And then you got the golden ratio looking really good. Now, generally, we want to move in this direction, in the north to the northwest. That gives us higher return at lower risk if we can get it. So we're always looking for things that are this northwest quadrant of the data here. All right, so there we go. We can see how they are all together. I've taken the liberty to just kind of put this in a slide so we can kind of see the risk for this. I estimated about 9.1% standard deviation, and return about 7.2 or so, give or take. All right. Now, the next thing I'd like to show you is what I think are the two best metrics. Well, the best metric for risk, which I think is the Ulcer Index. And really, this is just a sense of how bad the downturns are, how steep they are, and how long do they last. And you can read, as I said, you can read more about the Ulcer Index on my blog. But it's a great, just an intuitive way to figure out just how bad things can be. And one problem with standard deviation is it includes spikes upward as much as it does spikes downward. But spikes upward don't bug us, right? It was really those down periods which cause us the stress. So got Ulcer Index for risk, and then I like to use perpetual withdrawal rate when I'm talking about risk parity portfolios, because that's really what we're into. We're into portfolios that we can consistently draw on for living expenses, and perpetual withdrawal rate is the rate at which you can draw without that original money going down to, with that original money staying at least where it is. So if we start with $1 million, what can we draw to keep that account always at $1 million? Now, one flaw in this is there's inflation, so $1 million 20 years after you start is not the same as when you begin, but you get the picture. It's sort of keeping that initial capital where it is. And it's contrasted with safe withdrawal rate, which just says you have to be positive. But anyway, sorry for the digression there. I like perpetual withdrawal rate, and it gives us a sense of really what can we take and still leave something to the next generation. All right, so there we go. There's the golden ratio portfolio coming in quite strong, a little bit lower in terms of return from the golden butterfly, and a little bit more risky. So in this case, the golden butterfly would be the best portfolio for these metrics. But once again, just the broader point is you can see the total stock market is way over here on the right, very risky, and perpetual withdrawal rate is not that great. And actually, and this is a longer discussion, but those are related to each other because of the riskiness, the ups and downs of the total stock market portfolio. You can never really count on taking a really high percentage from it because you don't know what phase it's going to be at. So this is a really good indicator of how this golden ratio portfolio is really going to be quite strong when it comes to something you can rely on. All right, so those are that right there was just the basics about how to use it. I've marked it down here. You get 4.1 for Ulcer Index and a 4.9% perpetual withdrawal rate. Now, to really show you how this tool, where it can really work for you, let's see what happens when we tweak the portfolio just slightly. So we're going to try here a slightly more aggressive version of the golden ratio. We're still going to keep this mathematical symmetry that Frank loves, but we're going to take out the cash. We're going to knock down the gold from 16% to the lowest allocation, which would be 6%. So basically gold is taking the place of cash. And that gold's original 16% we're going to put in international stocks. So let's see how that changes things. All right, so I'm going to go back up here. I'll put in 16 here for ex-US total stock market. We'll take the cash down to 0, and we'll take the gold from 16 down to 6. All right, so we still have the same number of asset classes. We basically just put in a little bit higher equity percentage overall. All right, now let's go. We're going to try our basics here first. Standard deviation for risk and average return there. Okay, and this is this chart. All right, so once again, total stock market over here, permanent portfolio, sort of the opposite version, and the golden ratio showing very nice metrics with a really good return at 11.3% average over the past 52 years, 7.7%, standard deviation of 11.3. All right, now let's go to my two favorite metrics, Ulcer Index for risk and perpetual withdrawal rate for return. And here we see a slight difference, all right? So this more aggressive version of the golden ratio is going to return more. And if you don't need it to live on and you're, say, 10 years, 20 years from when you need the money, this more aggressive version might be really good because it's going to have a higher average return. However, if you were trying to live on it, this more aggressive version would come with a cost. Your portfolio, your perpetual withdrawal rate is going to be a bit lower, and your Ulcer Index is going to be a bit higher. So it's going to be a bit more stressful to hold, and you can't reliably take quite as much as you could compared to that original golden ratio, the one that that Frank made originally. So here you can see what happens with this new version, this aggressive version of the golden ratio, this international stock, the one that includes international stocks. You've got an Ulcer Index of 7.8 and a perpetual withdrawal rate of 4.4. All right, so here I just put them all together, and you can kind of see what we're learning from tweaking these allocations and adding a different asset class, taking an asset class away in terms of cash. You've got this original golden ratio. This is Frank's original formulation. 9% standard deviation. When we made it more aggressive, we took on more volatility risk. We went up to 11.3. The amount of ulcers that we can expect, and again, this is an index number, goes from 4.1, almost doubling really with this more aggressive version. On the other hand, our average return went up. We got 0.5% more, and if you're talking about a 20-year time frame and you've got a substantial amount of money when you start, that 0.5% is going to make a big difference over the long run because of compounding. So that 0.5%, if that's where you are as an investor, would be really great. If you were 22 years old and 40 years away from retirement, this aggressive golden ratio, if you only could choose between the two, might do better for you. However, you can see here, if you are in the withdrawal stage, if you're in the decumulation phase, you've now had your perpetual withdrawal rate go from 4.9% that you could reliably take out and still maintain your original capital. You've lost 0.5%. You're now down to 4.4. Okay, so kind of see that by tweaking things, changing things, some things are going to get a little bit better, some things maybe a little bit worse for your situation, and depending on what you're looking for, you kind of see how those different choices can affect the outcome. All right, so last, before I finish this tutorial, best way to learn more, go to the tool, try different asset classes. You'll get a sense of how they function. You can change allocations, of course. There are 18 portfolios on portfolio charts that you can enter in and kind of see how those work. If some of them really strike your fancy, take the original, tweak them, change them. Notice what changes, notice the results of the changes that you make. There are 7 portfolios on Risk Parity Radio. Now, some of those are duplicates. Frank has some on Risk Parity Radio that are the same as the ones on portfolio charts, mostly because they're famous, they're just widely used. So take a look at those 7. And I have 11 portfolios on Risk Parity Chronicles that you can look at. Again, some of those are duplicates. I have the Golden Butterfly there, and I have a couple of the biggies. I have some benchmark portfolios, but I also have some original ones. Now, some of mine, just like some of Frank's, I should say, use leverage, so you can kind of see how using leveraged ETFs can make a difference. Again, that's not saying that leverage is right for you, but you kind of can play with it and see what that does. Take any of those sample portfolios out there, and that's a lot to choose from, really, and sort of build your own and see how things change. All right, so that does it for me. You can learn more at riskparitychronicles.com. I welcome your feedback and your questions. Feel free to email me at riskparitychronicles@gmail.com, and also give me a follow on Twitter at RP_Chronicles. And of course, you can subscribe to the blog if you wish to get all of my latest posts. All right, thanks very much. Bye-bye.